What's up, everybody? It's another week, which means it's another happy hour. Ask me anything. Cheers to everybody. And I got to tell you, the Twisted Beak. Hannah, this is a good one. You need to try this thing, the Twisted Beak. What was everybody else drinking here?
I have a Moscow Mule.
Whoa.
Whoa.
In a bottle.
That's crazy. All right. So we got lots of stuff happening here, folks. And I hope all of you have your questions. We've only got a couple pre-submitted. So get your questions ready because me and the gang are going to be back to have a couple drinks and answer your questions. We'll see you in just a second. All right, welcome back, everybody. It's another week. It's another Ask Me Anything happy hour where we come on and do nothing but serve you by answering all of your questions. And to answer your questions, we found that it would be a lot easier if we just had a cold beverage while doing it. It just sort of makes the time flow by a little bit better. But, I'm going to open this up. And, we got two things that are super funny. Number one, Craig did a really cool video that I want to make time to play today in between answering questions. And I got another one here, and this is from Steven, Mr. Snaggy. This is his quote of the day. I want all of you to really listen to this. He said, "The market tanked today. Always feels good in a weird kind of way." Is that how you guys are all thinking? When the market falls apart, are you being like, yes? Or are you like, oh, crap? What side of the fence are you on? Because that will tell us a whole lot about how much you've been listening to what we've been trying to warn you about and tell you about for, feels like the last decade, but it's really only been probably the last year and a half. But let's dive into it. Gabby, what do we got for questions today?
We'll start with Brian. Brian is asking, he wants to talk about the cash value line of credit. The policy you just started, the agent's letter that they sent him says the purchase of an IUL program. Is this the same thing? Should he reconsider it?
IUL? Oh my gosh. No, I can't take this one. I've already had my rant earlier in WTF. It's been a rough day. Can someone else please tackle this one?
No, Hannah loves IULs.
Actually, I was talking with somebody earlier today about IULs. He was a smart guy. He's 24 years old, big real estate investor. I don't know. I can dive into it now. So this is a total separate letter from a separate company that I assume is not affiliated with the Money Multiplier. Is that right?
Well, last time I checked, Money Multiplier does absolutely nothing with IULs and will continue to do nothing with IULs.
Correct. I guess the reason why I'm asking that question is thinking about One America's dividend payout option. You know how you get that letter that you can invest a portion of your dividend into the S&P. So that was what I was thinking that Brian may have gotten. Anyways, we don't do that though. We just simply throw away that letter. But no, you don't want to do an IUL, right? Go to Nelson Nash. I believe it's page 19 of his book where he talks about his thoughts on IUL, and verbatim in there he says, "I do not recommend IULs for the infinite banking concept." We can get into it deeper, but here's the high levels. I want guarantee, safe, boring growth where I keep my money. This is just my savings account, my glorified savings account. And then what I tell folks is that if you really want an IUL, use your cash value inside of your banking policy to go buy the investment of the IUL, right?
So quantify that. So what Hannah's saying there is instead of buying an IUL, do the specially designed whole life that we design, take the loan from the whole life and go buy the actual asset, the actual stock or index that the IUL claims that you participate in, because you don't even own the investment inside the IUL, you participate. So if your rule for investing is buy low, you're not buying low in an IUL. But what Hannah's saying is take the loan from your policy, go out and actually buy the underlying index, and then you are buying low. It's a very smart idea. Thanks, Hannah.
Hannah's smart.
I just personally don't understand why you would tie life insurance to an investment product. Use the cash
commissions. They pay for commissions.
I know.
I don't know.
And actually, if you really want to peel back the onion, go back and look from a historical standpoint of why IULs even came about, you know?
Why? Because VULs completely failed and fell apart? Sorry. I actually owned a VUL, which is the predecessor. Is that the right way to say it? The predecessor, the pre-IUL era. I'm old. And it was the hottest thing back in the 2003, 2004 era. After the dot-com crash, we were buying and slinging VULs all around the place. I owned one. I sold tons of VULs. And the difference between a VUL and an IUL is a VUL actually is investing directly in the mutual funds, in the asset class. So you are taking a position in them. So in 2003, like we had a lot of people doing them, and how we sold them is, you know, put your money in this and you're going to get the upside potential of the market, and it's going to be all tax-free growth, kind of like playing off of the Roth IRA thing without all the rules of a Roth IRA. IULs, well, VULs bombed. Some of them went belly up, and the only reason VULs even exist in today's world is because the insurance companies, basically in 2008, 9, and 10, they made it so that the policies couldn't lapse. And then some joker in the actuarial department said, hey, that's kind of cool. Let's put a floor on these. Let's actually just have I don't even know how the whole thing came up, but it was just some magical idea. But at the end of the day, I want you to understand this. If any of you are looking at IULs, like, just stop. It makes absolutely no sense right now to buy IULs. But the other thing I want you to look at is, why do the insurance companies and the brokers love IULs? Why is it all you ever hear about? There's two reasons. Number one, an IUL and a VUL puts all the risk on you. On you. The insurance company gets to offload all the risk off their shoulders, and they just throw it right back on you. Here you go, client. All the risk is on you. Oh, and then by the way, we're going to charge a shit ton of fees to you too for these things. Oh, and by the way, we're going to pay our agents big old fat commissions on these products because, hey, we want them to sell more, and we know how to get them to sell more of that term insurance, and those IULs is to pay them a higher commission, because then we know they're going to go out there and say it's the greatest thing since sliced bread. You need one of these IULs. And then when the clients all start crying that they're not performing, which, oh, by the way, they're not performing right now, then all of a sudden the agent's already out of business. The insurance company's like, sorry, we gave you the contract and all the stuff was right in there. You didn't read it. And you look at it regular, you turn it sideways, you turn it upside down. You'd be like, who the hell understands what this says? The attorneys, folks. They're the only ones.
Good thing Chris didn't want to talk about that today.
Which one did you classify as the spawn of Satan?
Oh, gosh. The spawn of Satan?
Was that the VUL or the IUL? I couldn't remember.
I say developers are the spawn of Satan. I
Oh.
probably would say that VULs were the spawn.
Okay, there you go. I knew it was one of them.
Oh, gosh.
Developers of the IUL or just tech developers in general?
Just developers, just with Private Money Club. I've referenced developers as the spawn of Satan.
This is probably a really nice transition for Craig's video, right? Because this is one of the reasons people come to us with IUL questions, because their illustrations on paper are going to kick a whole life's illustration all day long, every day, always, right? So like they're coming and they're confused. They're like, well, look at this spread. I'm guaranteed it's going to make 7%, 8%, this over 20 years. And then like Craig's going to come in and say, well, no, you have to look at why you're doing this. You're doing this to move your money. You're doing this to take the banking function back. And we're not looking at the spreads. What is your money doing? And Craig will show us how you can win a beer.
Yeah. I mean, ultimately that's the key. You get your free beer and you learn some cool math tricks.
Can
Yes.
someone play that video? Because, I mean, hey, listen, how many of you want free beer? Because Craig's video is giving out free beer. It's great.
I'm jealous every Wednesday because I go to a Taekwondo class after this, and I would not go to that class with any kind of tasty beverage in me because it would be a bad choice.
Oh, it's brilliant. It's brilliant. Can we play that?
Yeah, 2 seconds. Here we go. And there you have it.
All right, let's be honest. How many of you earned a beer? Anyone earn a beer? I'd love that.
Everybody says that 6 minus 4 is 2, so you lose 2%. You will always lose 2%. So that's the bet right there, folks.
No beer for you.
No beer for you.
No beer for you.
All right, what else we got? Got any other questions?
Not on my end. Everybody's sleepy.
I got a little one. I thought this one was a good one. All right, I got a Facebook message. So if my annual premium is coming due, it's $12,000 a year, and I have loans that are outstanding. It's saying on my payment notice form of a $12,000 premium due plus the interest on the loan. If I pay my $12,000 premium plus the interest, will I mech my policy by doing so? And I'll have someone else answer that. Does that question make sense?
I might need it one more time.
Okay. So somebody's premium is coming due, right? They've been using their policy. They have a loan outstanding on it. Let's make believe that the loan outstanding is X amount of dollars. They owe $1,000 for loan interest. Okay. So their premium is coming due. Their next anniversary date is coming up. And they got their statement in the mail saying, hey, premium notice is coming up. You have your $12,000 premium that you got to deposit into the policy. Plus you have this loan outstanding and the interest. So he's asking if he pays his premium plus his interest, will he mech his policy?
Oh, no, not at all.
Absolutely not.
Not at all.
Do y'all want to elaborate on why?
Yeah, the loan interest that you're paying to the insurance company is interest that they charged you for lending you the money against your, they used your cash value as collateral. They lent you part of your death benefit. And when you're paying just the interest on the loan, that doesn't count toward the MEC rules. The MEC rules are your premiums versus your death benefit. It's a calculation over 7 years for X amount of premiums you're putting in, and you need X amount of death benefit to support that much of the premiums. That's essentially the MEC rule in a simple way. So when you're paying the interest on the loans, it has no bearing on that. And even when you're paying the loan back, that has no bearing at all on the MEC rules. So you're in the clear. Safe.
Good. So yeah, no, I just wanted to hone in that loan interest is a totally separate bucket than premium and how it gets calculated into the policy. So any loan interest that you pay really doesn't count towards your MEC limit whatsoever. Because honestly, policy interest that gets charged you at the end of the year, that goes directly to the insurance company, right? I see a cat in the back of Gabby.
Wasn't that cool? Like behind Gabby, a cat just like scaled down the wall.
Yes, like vertically down the wall. That was cool.
All right, I got another one. I'm just going through the Facebook group. Let's keep going. All right. Good evening. I'm new to the group and I have a question. Is it better to have a Roth IRA or an IBC?
IBC.
Yeah, it really depends on what the person's doing, but it'd be hard for me to ever tell anybody it's better for them to do the Roth. I mean, there are unique situations, which I'm going to have Steven share, like a real estate investor or a wholesaler. Using a Roth IRA might be far more advantageous than using an IBC from a tax standpoint. But in normal situations, the IBC is going to be a lot more flexible. Steven, do you want to hit on that?
No, it just depends what you're using it for. Like you said, I mean, if you're looking for, some home run deals and you're going to get them and you're looking to grow that money tax free and you don't need the money right now or in the foreseeable future, it's designed for retirement. If you pull it out early, it's penalized. So, there's certain situations like, you can use an extreme situation with like Peter Thiel, who was one of the co-founders of PayPal when he took $2,000 from his Roth IRA, invested it wisely in PayPal and other companies, and grew that to $5 billion. So he created $5 billion minus $2,000 of tax-free wealth using a Roth IRA, where you can't do that with a banking policy. I mean, anything you're borrowing from the banking policy and investing is all taxable income at that point. So that's where you need to take advantage of things like complex trusts and foundations to create, to disregard the tax portion of that. But so it's just different strategies for different people, what you're doing with it, what you're using it for. And there's no reason they can't work together and have both. So
I agree.
And Stephen, I'm getting a lot of questions about, hey, I have an IRA and I'm invested in the market. What else can I do with this? So, we talk about the self-directed IRA, those types of things. So you might want to expand on that because, those offer some additional benefits to getting out of the market, doing non-correlated market things, private lending, real estate with your IRA.
Yeah, 100%. Just to clarify, a self-directed IRA is an IRA. So it's the exact same thing, whether it's a traditional, whether it's a Roth, whether it's a SEP or a simple or an HSA. It's the exact same thing. It's just self-directed simply means it's with a custodian, with a broker that allows you to invest in things outside of the stock market. So what are considered alternative investments. So things like gold and silver, precious metals, real estate, private lending, businesses, intellectual property, startups. It opens up your options of what you can invest in with your qualified funds. That's the bottom line right there. The qualified funds. I mean, if you put them in this IRA, they grow tax-free or tax-deferred, whether it's a Roth or traditional, as long as you oblige by the rules and the regulations. You can't touch the money until you're 59 and a half, et cetera, et cetera. So examples of a traditional custodian or broker are things like Charles Schwab or Merrill Lynch or TD Ameritrade or your financial advisor, Ameriprise Financial, New York Life, whatever it might be. Those are traditional IRAs or accounts you can set up that allow you to invest in the stock market, bonds, options, things like that, where somebody like Horizon Trust Company, Equity Trust, NewView, one of these self-directed custodians, the only difference is what they allow you to invest in, which is everything else. So we work a lot with Horizon Trust. So if you have like a Fidelity or Schwab IRA, it's really simple. You just get on the phone with Brandy, who's our dedicated account executive for all of our clients and students, and she will literally open the account with you. You guys will call whoever your money's with now, have the money transferred. There's no cost. There's no fees to transfer the money, no penalties from the IRS, anything like that. It's just moving it from one broker or custodian to another broker or custodian that gives you a lot more options. So that's really all it is at the end of the day. Taking control of your money. That's what it's all about.
Stick it to them. Actually, no, that was very good. I learned something new. Hey, let's talk about this. Eve, I'm curious about this as well. Can you educate me on the cap limits between like Roth, self-directed, and how much you can contribute?
So how much you can contribute on IRA accounts?
Yes. Well, what are kind of like
the
limits?
I don't know if they were upgraded this year. Typically, your contribution limits are annual, so I think they're 6,500. They might have bumped up to 7,000. I have to Google it, but I think they're 6,500. That would be for a Roth IRA or a traditional IRA. So you could technically put 6,500 into each one of those. A solo K, if you have a business and you open up a 401k, but if you're a solo entrepreneur, for example, it's called a solo K. Those limits are based on your company's income, but you can get up to like 55 to 65,000 in those, depending how they're structured and set up and how your company's structured and set up. So you can get more into those sometimes. As far as Roth contribution limits, if you make a certain amount of money, you can no longer contribute to a Roth. So if you make over like 200 grand a year, I think it is, you can no longer contribute to a Roth. So you can have one, you can own one, you could convert like a traditional to a Roth, like a backdoor, they call it, but you can't contribute new dollars to it. You can grow it, you just can't contribute new dollars to it. So those are some of the basic limits. If you want to get more detailed, it's really just a simple Google, or just hop on with Brandy and Brandy can lay all that out for you exactly.
Good. Thank you.
Okay. So Josh Sneed was asking, were any of you denied your first policy?
No, but I got tobacco rated.
Wait, you got what?
I got tobacco rated.
Oh, did you really? Bad girl.
But then I went in about a year and a half later and I said, hey, I'm not doing that anymore. Update my health rating. And then they made me go down and take a urine test to confirm that I was telling the truth. And then they did update it though.
Oh, that's interesting.
It's good to know you can update a health rating if things change down the road. So it's something to keep in mind. And where I like that a lot, Hannah, is we have a lot of people that are like, well, I got a table rating, or I might get declined. So I'm not going to do it now. I'm going to work on my health first, and I'm going to get in shape, and then I'll apply. But we all know life gets in the way. So the beautiful thing with that is you can get started now, protect your family, even if it's a lower amount or a higher cost right now. And then when you actually do improve yourself, because the same thing can happen. I mean, you could be working out, you could be getting the healthiest person in the world, and then all of a sudden cancer hits. Like you can't control that. That can happen to anybody, anytime, with nothing you can do about it. And now there's no way you get any policy ever. So protect yourself when you have the ability to, regardless of the other factors, and then you can work on improving yourself and getting that better rating if the stars align. But don't deny yourself and have those what ifs. I mean, with everything going on these days, it's just, nobody knows. Cancer is a scary thing, man. Like it really is, and it happens to anybody, anytime, any way. And so, get it while you can.
My attorney's father, who was always, to me, very healthy guy, like spunky, like 65 years old. He came down with brain cancer, and like in a week, maybe it was 2 weeks, gone. I mean, she's gone. It's just insane.
Yeah. So Eve was just asking about PayPal, the PayPal thing with the Roth. So they do limit the Roths now. I think you can only have like two. Do you know how much it is, Chris? Is like 20 million or something, or 2 million a year in growth. The Roth does have a limit. It's most people, 99.9% of people will never have to worry about it. But
yeah,
it's just to her point.
Yeah,
They did stop after the
20 million, I think it was. They're just trying to avoid the Peter Thiel situation happening again. That's a lot of tax revenue they missed out on. So if any of you are investing in Private Money Club and you did it from your Roth self-directed IRA, could be a good day for you. Just kidding. Not really, though.
Skip mentioned he's trying to figure out IUL stuff. He has $30,000. How's that work? I think we beat that to death already. So yeah,
the simplest thing. Go ahead, Stephen.
Sorry, go ahead. I was just gonna say that's why I posted my email. I can send you a bunch of stuff on IUL if you want more stuff.
Yeah, definitely.
Just email me snaggy@themoneymultiplier.com.
Yeah, and I'll just say one thing. I mean, let's just look at the times right now, the economic conditions. We're in a recession. I mean, we're 4 quarters of declining GDP, which more than puts us in. What the hell? Something happened here. Hang on. All right, something's going on. All right. Anyway, so because we're in a recession, we can really make a solid argument, or just look at the facts and say that the stock market's going to continue to go down. So by putting money in an IUL, and most financial advisors, I was at an event and this financial advisor didn't even know what they were selling with IULs. They said IULs are better than whole life. That's all she said to me at the event that I just got done speaking about IBC at. Hannah, you remember that lady at the RAL event. But with an IUL, if you put money into one right now, what would be the reason you'd want to put money into an IUL? Well, because someone told you that the returns are really good and you got the upside of the index, right? And you're going to make all this money and they're going to show you this fancy illustration at 6 or 7% hypothetical return. You're not getting 6 or 7% right now. And you're probably not going to get that for the next year, maybe 2 years, as we are in this recession. So you're putting all this money, you're putting 30 grand in. The first thing you know for a fact is that you're going to make nothing. You're going to be at the guaranteed floor level, period. Okay, that's, I guess maybe if you put it in that stable value account, but pretty much just know you're making nothing. And then on top of that floor, you have to pay for the cost of insurance. So that's bringing you negative now. You have to pay the policy service fees. That brings you even more negative. And there's additional fees in the IULs that bring you even more negative. Okay, so right now, you know for at least the duration of this year and probably 2024, you're probably going to lose money. So by putting money in an IUL, you're losing money for 2 years. when you can put your money in a specially designed whole life and make money for 2 years. So right there, logically, I can't make any bloody sense out of that. I have some people say to me that, well, I want to put money in an IUL because I'm buying low. You have a lot to learn, because you're not in an IUL buying into the market. You're participating. The insurance company owns the index. The insurance company owns the basket of investments. They only allow you to participate into a certain limit or an uncapped, which allows you to go even higher. But uncaps are dangerous. You got to understand the magnitude of what you're getting into. Just you hear uncapped, you're like, oh, it's uncapped, I can make as much as the index does. Yeah, look at the flip side of that. It's not good. So you're going to lose money. Then IULs, every single one of them has surrender fees. Surrender fees, which means the money that you put in, you can't take back out like we do. You can't use that money immediately in the next 30 days like we always do. You can't do any IBC activities in an IUL because there's surrender charges, which means you put in 30 grand, you're not going to have hardly any of that 30 grand available. Not this year, not next year, not the year after, not the year after, not the year after. Usually the surrender charges are 6 or 7 years, maybe up to 10 years. So you're literally saying for, the duration of whatever the surrender period is, I'm not going to take loans from this policy. That really, like, we teach people how to take back control of their money, not how to give up control of their money to the insurance company. So right, that doesn't make any sense to me. And the very last thing that I can't rationalize with is most IUL policies that you're going to put money into are sold completely wrong. They're sold completely false. And you're going to see a whole bunch of arbitration cases about these. You just mark my word. I'd be surprised if IULs even make it through the cut after all these arbitration cases come. When the market drops and all these people that were told they're going to make a certain return don't make a certain return, can't get their money out. And if they get their money out, they're going to lose a bunch of money because of the surrender charges. And the agent told them all wrong. And the agent sold it as an investment when the agent wasn't even an investment advisor licensed, because IULs can be sold by non-licensed agents. So like, if you just put all that shit that I just said in a blender and you hit start, what do you have? Something you'd never drink in a million years. So why in the world would you put your money in an IUL? And if that's what you want, why are you on this Ask Me Anything? We're going to send you a bunch of videos. And if after you watch those videos, then watch Chris Kirkpatrick's videos, because he used to sell IULs and now he hates them and explains exactly the inner workings of why you should never do them. And if after you watch our videos on IUL versus whole life and you watch Chris Kirkpatrick's videos on IULs and you still want an IUL, please call your doctor and get psychiatric help.
And let me just add, I went into this on a video today that will be released in about 2 weeks, but let's bring it back to what we're teaching here about the process of the banking concept in your life. And you have to look at it if you really want to compare the different products side by side. I mean, you just can't. You got to look at IBC from a historical standpoint, where it has defied the test of times. I don't even think I'm saying that correctly. Where just IULs, they haven't, right? They haven't even been around for that long. So just something else to add into there, Chris.
Cool. Yeah, no, I mean, it's just, I just logically can't understand it. And I can't understand how now people are still talking about them like, oh, they're still the greatest thing. I just don't get it. What other questions we got?
Yeah,
Brian,
we'll close the book on IULs.
Let's not talk about those anymore. Didn't Brian have a cool question?
He's got a couple. He was asking, I don't know if this is the one you're talking about, but he's asking what investment opportunities are getting us all excited currently.
Well, I can tell you what I'm excited about. Yesterday, we did a group call for our private fund, Inicio, and we were talking about some of the new deals that Inicio is funding right now. The cool thing about Inicio is the only way somebody can get and take part in deals with our entire group that we're doing and all the knowledge of our group. So I think it's really exciting because Inicio was really put together and built so that, we had money in a fund to take advantage of the declining market conditions and buy deals ridiculously cheap when those opportunities presented themselves. Well, in the commercial world, the bigger deal world, like $1 to $2 million deal, there are deals left and right. And these deals are so freaking good. We got 2 deals. Like the one, I just don't even know how, our one partner found this deal. It's so ridiculously good. And like literally the risk tolerance on it is just unbelievably low, but the return is huge. So I wouldn't be surprised if this year in that fund, we see double-digit returns for our clients. And then, like a lot of people don't like Initio because, it only pays a 4% pref return. So you're only getting 4% interest. And that's kind of a bonus if you really think about it. Like there really should be no return because you're sharing in the back end profits and the investors are getting the majority, the lion's share of the back end profits of the Initio fund. So the 4% is really just almost like the icing on the cake. It's just a sweetener. And to get that 4% just gives you a little income, makes you know that we're committed to the investors. But these deals that we're locking in this fund, I mean, I haven't seen stuff like that since, my gosh, 2009, 10, 11. And this is early. Like we're just getting started. I mean, we're just peaking over 2.5, or no, I don't even think we're at 2.5, about a little over $2 million in the fund. In the deals that we found for that 2.5 million, dude, they're some of the best I've seen in a very long time. So I'm excited.
Yeah, I mean, just the deals I've been seeing come across Private Money Club. I mean, there's been some unbelievable deals. And, if you're not a member yet, definitely join as a premier member before tomorrow, because we are doing our 2-hour coaching at 6 p.m. Eastern tomorrow, Thursday. And it's for all of our premier members. And we're going to go through a bunch of new opportunities, deals. We're getting a little more depth on Initio and some other projects. So we decided to devote this month, since we're kicking off 2023, with deals and evaluating them and digging in deep. So if you want to learn how to do that, from the best in the business, then come join us tomorrow. So you just got to go to privatemoneyclub.com and join as a premier member, and you'll get registered for tomorrow's monthly coaching. It's going to be a good one.
Okay, Peter's asking, do you recommend putting all your policies into a trust?
Hannah, or Joe? Yeah.
It depends. It depends on what you're going to use it for. Depends on how the money is going to be taxed. I have one in the trust and one that's going to stay in my personal. So there's no easy way to answer that.
And that's for tax purposes. That's why you're doing that?
Yeah. And to lend from the business trust back up to the LLC to lend more money out, to bring it back in. It acts as a catcher's mitt before it goes down the ladder.
Right.
So, Joe, the other piece of that equation, typically in the trust, you're on the hook for food, fashion, and fun on your personal side, right? So the trust isn't going to pay for those things. So the life insurance on your personal side could be the mechanism to provide your tax-free income, say, where you don't have to, pull money out of the trust and get taxed on that, or have it flow from your business trust. So having a policy on the outside and your personal side would allow you to generate an income where you can pay for that food, fashion, fun later on.
You could, yeah, as it grows.
Yep.
So like Craig, to that, like I've got the same structure as Joe does, and the same structure as Brent, although I'm the rookie in the group. Like I just am getting rolling for 2023 now. I'm literally reading an email from Mahib with Wealth Builders Group. But I think what I'm going to do is some of my policies, I have 9 policies. Some of them will move into the business trust, but I'm definitely going to keep a couple of them outside of the trust just for that flexibility to have them there, because I don't pay tax on the growth inside the policies. I only pay tax on the activities of what I use the cash value for. So I'll probably keep, I don't know, maybe 2, maybe 3 of my 9 policies outside the trust. The rest I'll move in. I might move 1, actually I'd probably move 2 into the family trust, the remaining amount into the business trust, and then keep 2 or 3 of them out of the trust. I haven't fully decided. But I don't know, Hannah, does Brent have all of his policies inside the trust, or does he have a couple outside? Because he's got what, like 2,800 of them or something like that?
So actually that's what mom and dad are doing right now. They're up in Idaho. So I don't know like the latest scoop on that, but I know he is moving them into the trust. Trust is going to be the beneficiaries, I know. And then I'm not for certain if they're going to be, I imagine they're going to be all owners and all payers as well.
Yeah, I definitely would guarantee that.
Yeah, that'll be beneficial. Yeah.
I mean, I think, in this trust structure that we have, I think it probably does make a lot of sense to have the policies owned by the trusts. Because really, if you think about it, everything we do with this trust structure all runs through the trust. I mean, the operating company, and then it all flows through the trust and ends up in the foundation. So you really don't own anything. So why own the policies? Just have the policies be in the trust because they fulfill the greater purpose of it. So I think eventually, a couple of years, both these gentlemen are ahead of me. A couple of years, I'll probably eventually start transitioning policies into the trust. But for now, I'm just still learning and still just getting used to stupid little things like, which one of these trusts pays for my health insurance? That was one of my questions. I know it's stupid, but it's just like, I always find it's so different and fascinating to me that I'm just constantly trying to learn, like, okay, what about simple things like that? And the answers come back simple, stupid. And I'm like, oh yeah, I kind of knew that, but you're always questioning yourself. You ever find yourself?
What'd they say? The family trust?
Yeah. It's like family trust. It's just like, it's part of your family.
Come on, man.
Family trust.
Did he ever get back to you about the vehicle going into the family trust?
No, the vehicle is actually going to go into LC Strategic Holdings, my operating company. I did ask him that. Yeah. And actually on the health insurance, he said you should pay the health insurance personally. Like use that out of your draws. Out of pocket medical expenses can be paid by. But he did say, so like any deductibles. So I would pay the health insurance premiums myself.
Right. Okay,
but then he said the out of pocket medical expenses. So your co-pays, your deductibles, because we have high deductible plans, are all paid from Family Trust.
I think it's the same thing with education too. For you can pay that out of the family too.
What I appreciate about this is we're watching in live time. We're watching Chris learn new things, right? Like that's what people are here for, is ask us questions to learn new things and to see what the evolution looks like as we all grow in our wealth, our knowledge, and how to protect and take control of the money. Right. So I don't want to miss that moment that Chris is like being vulnerable and saying, I'm asking stupid questions, because it's the only way you learn. Like if you're not willing to ask the dumb questions of us and of the people that are helping you, then how do you grow?
I would have set out of the LLC for the medical, because then it could go either way. I mean,
I could pay out of the LLC too. And he did mention that, but for me, I'll probably just pay him personally.
Because that's the old way that we do. It's a write-off to the LLC, and then it would be income on the left, and you have to minus it from the right in order to play the game on the left. The old way.
See, like my whole structure, it looks like a freaking spider web. I'll just show it to you.
Oh my! Or wait, this is going to be fascinating.
I don't know why I can't show it.
Oh.
I think I don't know. It's a freaking.
Because you have them all separate, and then it all goes into the one, right?
Yeah, they're all.
Oh, that's awesome.
There's a lot of them. So I don't know why it's not letting me.
Yeah, Joe, I was kind of thinking back on the life insurance piece too, being on the outside, and anything on the outside, it doesn't have that asset protection either. So I guess the other benefit of moving everything into the trust is you've got that asset protection. Whereas if it's on the personal side, it's vulnerable.
Okay. You want to know the truth?
What's the truth?
When the policy per year is more than you make, you need to move it to the other side.
Okay. That's good info.
You got me?
Yep. Gotcha.
When the policy premium is more than you make, you have to move it over to the other side.
Yeah.
Well, while we're doing that, Peter had a question on who we use to set up all these trusts.
Wealth Builders Group. It's Suleiman. He's presented on some of the 3-day events and things like that. But all of us are using the same person to set it up because it's tried and tested within our family, if you will, here.
Yeah, and Carlson, Brent Carlson for LLC formation. That's what Brian's asking.
What else do we got?
Sam says, how can you leverage a Roth with, say, $10,000 to make a real estate investment deal on a condo you plan to rent out?
Nag, you want that one?
I'm going to check out. Actually, I got a call at 5:15 with a client. I told him I'd call him. So good to see you guys. Thank you. See you
Nagy.
Next week.
I'm trying to find the question here, Hannah, just so I can read it. Sometimes reading it's better.
Yeah, it's from Sam. It just says Sam.
How can you leverage Roth? A couple things. Is it the one how to leverage the Roth?
Yeah.
Oh,
Yeah.
okay. So I don't know why.
Can't you get close with self-dealing on that though?
So let's see, real estate. So what you could do with a Roth, and kind of the best way I've found to use, and Greg Hurling talks about it a lot, is if you're a wholesaler and you go out and you find a deal, a really good deal, and you put an earnest money deposit down on that deal. Let's just say it's $1,000 to secure the contract for buying that property. So you do a direction to invest for the $1,000, and you have the $1,000 paid from your self-directed IRA. So technically, your self-directed Roth IRA is the owner, or the I guess it would be the owner of that contract that you just inked and that you just put a deposit down on. Now you go out and you find someone to buy that property, to sell that paper to, because you got the contract, which means you got the right to buy it. So let's just say you sell that contract for $15,000. So you put $1,000 in, and you got $15,000 you just made. That profit, when you close on that deal and they close on the property, $15,000 from the title company or the attorney is going to come back to your Roth IRA. So you literally just made a $14,000 profit, and that's all tax free. So that's a really good way to use the Roth IRA, because it shields the tax on the profit, right? Because it's all owned by the policy. You could do the same thing with real estate too. You could have the Roth IRA buy the real estate and own the real estate. There's more moving parts there. Piece of paper and a contract's real easy. I mean, there's no lawns that need to be mowed, because if your Roth IRA buys a property, then your Roth IRA owns the property and has to maintain the property. So you can't technically, pay out of pocket to mow the lawn or for the hot water tank when it goes. The Roth IRA, which is the owner, has to technically fund all that. So it gets complicated when you own property with a self-directed IRA, but it's actually not hard, because there's check writing self-directed IRAs that work for that really well. But I think wholesalers really should benefit from Roth IRAs, self-directed Roths.
Okay, and Brian says, what would be the difference between a standard and preferred death benefit? Say about $10,000 premium for both cases.
What would be the difference? Not much.
It's not much.
I mean, maybe definitely the death benefit would be lower. Cash value might be affected, but it'd be minor. I mean, very minor. I'd say the death benefit would be the biggest thing that would be dropped. But I mean, standard versus preferred is.
I would, if I have to throw a number out there, I would say I can't even throw a number because so many different factors play into it.
It's a tough one.
Yeah, it's just age, health rating, all of that stuff, policy design. I mean, if we are, I don't know, if I had to throw a number out there, anywhere from 2,000 to 5,000, I have a feeling would be the difference.
And kind of on the same note, Dexter was asking, how often can you apply or try to get a better health rating? Is it one time only?
One time a year.
Yeah, no, I think you can keep going back. I haven't done it, but I why not?
Yeah, you could try every year, and you should. It's not very hard to do.
And actually, real quick before we go on, to go back to the one question about, hey, have y'all been denied for your first policy? I have had folks though who have been denied. They'll go out, or maybe they get postponed because they have some pending specialist testing that they have to do. They'll go do it. They'll send in the results to the underwriter, and then, hey, now they can get approved and get the policy. So being denied doesn't mean that you're off the table. No one's touching you forever.
Definitely.
Okay, Derek says, when I loan money out on Private Money Club, is the interest taxable income, generally speaking, as an individual, not an LLC?
Yes, of course.
When you make money, you pay tax.
Bingo.
Joe, you keep it simple, man. Thank you. Well,
Yeah,
I'm out on that note. So see you all next time. Enjoy mojito in a bottle, or your Moscow Mule in a bottle.
Moscow Mule. That's right.
Carol.
Okay, Marvin says, can a non-resident living in the U.S. own a policy? Must they wait to have a social security number?
Hannah?
Yeah, no, you can. You can own a policy. If you're a non-resident living here in the States, you must be here though on a working visa or maybe a green card, and you have to have a U.S. bank account. You got to have a U.S. address, and you just got to make sure that you're here in the States when you complete the application and the exam. But yes, it can work.
Okay, Marvin's got another question. He says he's 11 years into his policy with One America. His booster rocket, the PUA, is still attached. When it eventually falls off, how would I know when it will fall off and how far in advance?
Well, actually, at One America, you got to request it to fall off, unless it's designed to fall off at a specific point in time. But if you ever want them to fall off, you got to call them up. How would I know? I would personally just call them and request an in-force illustration and just see how that policy is set up and designed and see what's going on with it.
And Joe, back to the trust question when you were saying move it to the other side.
Mhm.
Tommy's asking, what does that mean? Move it to the other side.
Well, one side is the personal with the 1040 that goes off your social security number. The right side would be the business trust side. That would be the 1041 tax structure. So when the LLC gets bifurcated, you can depict what percentage goes to what side because it's a partnership. It's you on one side and the business trust on the other. So when I said the right, I meant keep it over on the trust side, if you will. Did I answer that right, Chris?
Yeah, I think the easiest way to look at it is, with this structure, you sort of from the LLC, from the entity, or from the operating entity, you draw an income from that. And that income is going to be taxed just like anyone else's income. It's 1040 taxed income, and you can dial that to be anything you want. You could be $10,000 a month, or $1,000 a month. I mean, it can be anywhere you need it to be to, like Craig was saying, to pay for your shoes and your clothes and going out to dinner and all the stuff that you can't run through the trust system. So there are things, and your normal expenses. So you could dial the income to be anything, but any other income that's not, taken out flows through the trust system, goes to the business trust and the family trust and the foundation. I think and I like the idea of having the two sides, left and right, because really left side, you're going to pay tax on any income you take out of that LLC, which can be any amount you want. You pick and choose. Whatever income goes into that LLC, you can take any amount you want out. And anything you don't want to pay tax on, well, you just run it through the system. And you just run it through the business trust, which then is there for the benefit of the family trust, which is there for the benefit of the foundation. At the end of the year, it all ends up in the foundation. You donate 5% or 10%, whatever you want, and then you manage the foundation's assets at the end of the day.
If he wants to shoot me an email, I can talk to him about it too. Joseph@chrisnagel.com.
And Eve says the new health rating is only for new policies, not ones already in force, right?
Correct.
Wait.
I think he's talking about going back time getting new health rating on an existing policy.
Rating is open for new policies, not. Oh, no. Eve, you can, I read that wrong. You can go back and request a different, you can try to get a better health rating if your health has improved. A lot of people, like if they're maybe a bit overweight or, a little short for their weight, a year later they go on a diet and they lose a bunch of weight, they can retest. Or a smoker gets, Hannah decides to puff on a big old fat, what do you call those things? And gets dinged for nicotine. And then the next year goes back and retests saying, I'm not a smoker. Can I retest? And they find out, oh, you're not a smoker. And then the rating goes back up. So really, you can do it while your policy's in force and get better rating. I've seen it happen a lot. People retest all the time. I can't believe I forgot what those are called. You can tell I'm getting old. Holy shit.
Vapor? Vapor?
No. Blunt.
Oh.
There we go.
I think you could put that in the vape now too, though.
Oh, geez. So you can have heavy metals too.
Hey, to go back.
Go ahead, Hannah.
To go back to Brian's question though, real quick. Okay. He was talking about cash value, not death benefit. Why were we talking? I think why we were thinking about cash value is because we always say, the cash value is not going to alter with that health rating on the policy. Right? Yes. Okay. Could change a little bit if I have my sleep apnea folks who aren't using their CPAP machines at the end of the night and following up with their doctor. Y'all know who I'm talking. Y'all know who I'm talking to out there. But it's for it, right. So it can alter slightly. But I kind of would go back to my same answer. Like what $2,000 difference if I were to compare apples to apples, like a super elite preferred versus like a table 6 overweight tobacco smoker,
For sure.
Well, I don't see any more questions coming through. I think that might be it
knocked
for the
them
day.
all out, huh?
We did.
Good stuff. All right. Well, it's been fun. I got to go back and I got to film 4 more videos. So we're going to get that done. And folks, we will see you probably sooner than you think. Thanks everybody for being here. Thanks for making this show awesome. We had over 50 people today. That's pretty badass. And we'll see if we can just keep building this thing and making it good. Talk to you next time.
Bye, y'all.